Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 3 o'clock in New York. It is Thursday, 5th day of November, 2015, and this is the Daily Report for Gold and Silver. We have the precious metals complex continuing on their downward drift. Not off that much, off about $2 on the day, 1104.30. That's with a high of 1111 and a low of 1103.60. We'll talk about the 1103 area in a second. Of course, tomorrow we do have a jobs report coming out, and it's almost the quiet before the storm as traders and investors await those numbers. I want to start the show out by looking at a daily chart, standard candlestick format, and we talked about different key areas, and I have adjusted actually one of my key fib levels, and this actually came in as a suggestion from one of our subscribers. By looking at the real bottom, I was putting my fib retracement in terms of the start point roughly in this area at around 1080 rather than the real low that came in July, which is around 1071, 1072. So by beginning at 1071, 1072 up to that same price point, 91.92, and then looking at our 75% retracement, that comes in at 1102. There is some solid technical evidence in terms of having gold find some support either right in this area around 1100. That's a key level of support. Two, maybe these lows that come in at around 92, that would be the lows that the session lows that we saw, I should say intraday lows that we saw back here in September. You can see that we hit some lows here. But I really believe that there's a strong opportunity that we will see support at this level. Of course, up till this point, we have no technical data or evidence that we've got any kind of key reversal. Traders, the next thing I want to look at is a couple of historical data points. First of all, I have a basic daily chart, but I've compressed it as such so that we can take a look historically speaking and see if we can glean any technical information about the last time this market was actually trading at this point, which happened to be October of 2009. And you can see there's a huge area of congestion here. This is when the market had really tracked to 1,000 for the first time. That's right here. And then from there, we had the market clip up and actually hit a high of about 1250, if I remember correctly, before coming back down to settle right below 1,000 at about, call it 1050. So in terms of long-term historical levels, those are the levels we want to look at. We do have some historical data at this point, but it's not really conclusive. And what I mean by that is we're not seeing a defined level of support at that particular area. Now, the next thing I want to do is really blow this chart up because, as I said, this is a Japanese average chart, and we've been really using this type of chart to determine whether or not the current trend that we're looking at seems to be waning at all, if it's losing any of its steam, or if it still has a good level of energy. Now, based upon studies from our Japanese average charts, we cannot say anything except that we still have some pretty strong momentum to the downside. Body size remains large, although it has actually contracted just a little bit from these prior candles, lack of any upper wicks. So that tells me that there could still be some energy within this particular sell-off here. And then the one caveat to that is looking for support at roughly the 1100, 1105 area, and that's the area that we are currently at. So traders, even with this dramatic sell-off that we have witnessed in the market, and this sell-off really began when the market traded to that intraday high of roughly 1191. That was a pretty substantial rally from 1071 to 1191. So we had a good solid move in the marketplace. And of course, ever since that, we have seen this market come under pretty extreme pressure. Now, there's a couple of indications, as I said, that we should be able to see some sort of support come into the market. No technical confirmation, but I draw your attention to the chart that I pulled up. It's also a daily chart, but I have a linear regression that we have added to that, and that simply puts in the channel lines. In this case, it is obviously a bear channel, and we are absolutely at the bottom of this channel. So this is a point we would look at for the market to move back up the channel, even if it still remains in a bearish mode. There's another linear regression that we've done, this on a much more short-term chart, a 240-minute chart, and we're close to the bottom of the channel on this chart, but quite honestly, not at the bottom. There is still some room to go there, without a question of a doubt. And lastly, short-term study, 240-minute chart, moving average convergence divergence, or MACD. And you can absolutely see that we are starting to get across here, and we're also getting a pretty substantial shift in the momentum or strength of the current trend, and you're getting it right in here. You can see that waning with the fact that we have the jobs report coming out tomorrow. Expect increased volatility. So traders, to give you an idea of the kind of week we have seen, and realize we still have yet another day to go. This is a weekly chart, standard candlestick format. We are on the lows of the week. The market opened at the highs of the week, and of course those highs were roughly at 40.41, 11.40, 11.41. Market trading right now very, very close to $1,100. Recommendation: we have been sidelined. Let's see what the jobs reports say. Secondly, let's let the whipsaw kind of work itself out of the market, and at that point, ascertain whether it makes sense to initiate a position in the market. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow following the jobs report for the weekend review. Bye-bye.